Hi, my name is Larry Gaines and I'm the founder and moderator of Options on the Open. Options on the Open is the only 100% option day trading site where all trades are closed out the same day. At Options on the Open, I teach our members how to day trade stocks using options. Since all positions are closed out the same day and none are carried forward, there is no need to worry about time decay of an option. And the most important component for setting up a good trade becomes the strike price that is selected for the underlying stock. I tell all my students that option prices are just numbers, and anything with a number in a liquid market can be traded as long as it goes up or down. With options, we can set up trades with controlled leverage, which is a more efficient use of our trading capital. So the most important element of the option day trade becomes the entry and exit price of the option strike and the volatility and the delta of the option. The option delta becomes very important when day trading stocks. Using options, it is very important to be able to manage the price movement in a way that will allow you to stay in the trade longer. And you can do this through the correct use of option deltas. And you will also be able to generate higher returns on your trading capital. So what is an option delta? The option delta is the rate of change of the price of the option with respect to its underlying security's price. The delta of an option ranges in value from 0 to 1 for calls and from 0 to -1 for puts, and reflects the increase or decrease in the price of the option in response to a 1-point movement in the underlying asset. Far out of the money options have delta values close to 0, while deep in the money options have delta values that are close to 1. So if we are trading a stock that has high volatility and large intraday price movements, you can use the delta of the option to reduce and smooth out sharp price movements, plus maintain the use of leverage to generate higher returns on your capital. Here's an example using Apple. What you see here is the option chain for Apple. The option chain will give you all the strikes and other elements of an option, which are referred to as the Greeks. I selected the option chain here for Apple, and I will go through this with you. This is the September 2010 option chain, and for this example, Apple is trading at $250 a share, and we're going to look to buy 100 shares, so we would use 25,000 capital if we're not using a margin account. So as you can see here, here's your delta, your gamma, your theta, your vega, the bid, the ask, and the strike. That's what it'll look like on your option chain. There'll be some other elements to the option chain, but for this example, I wanted to keep it simple. So here are your strikes. You'd first look at the 220, the 240, 250, 260 going out. The stock, as I said, is currently trading at $250. So in order to get a smaller delta, the further you go out, the smaller the delta gets. So here, for example, here's 220, that's in the money. You can see it's 0.9748. As you go further out, the delta gets smaller. So I select the $260 strike. It has a delta of 0.30. So let's say we buy the 260 strike. It's currently, the ask is $1.70. So $1.70. Remember, each one contract of an option contract equals 100 shares. So we would spend $170 to put this trade on. Say Apple goes up to from 250 to 253 on 100 shares. That's $300 profit on the underlying stock, which would be a 1.2% return. Your profit, however, on the Apple 260 calls with the delta 0.3 would be 0.3 times 300 equals $90 per contract on that option. That's for one contract. So your return on capital would be 52.94%. 90 divided by your capital outlay of 170. As you can see, the returns skyrocket because of the use of leverage, but you can also control the price movement because you're not going to move one-to-one. For every $1 movement on the price of this Apple stock, it would only be 30 cents price movement on the actual option. So you get the benefit of controlling price movement, staying in stock longer, plus the use of leverage to increase your returns. I hope you enjoyed this example. Please tune in to optionsontheopen.com. Thank you very much.